As the rest of the stock market continued its earnings party, it peaked back at NVIDIA, like a 20-year and 11-month-old kid holding a beer in view of their dad at the barbecue looking for approval. At first glance, NVIDIA beat most of Wall Street's expectations in revenue and profits, but there were also red flags that made investors antsy about a possible AI spending slowdown and pushed the chipmaker's stock down 3% in after-hours trading. With everyone looking to NVIDIA, which supplies key parts for AI companies, as a litmus test for the health of the entire AI industry, the company reported solid growth and rising sales, with net income up 59%. But following explosive growth that propelled the company to a $4 trillion value, NVIDIA offered a tepid revenue forecast. And investors looking for cracks in the world's most valuable company's facade also noticed. Data centers missed the mark. NVIDIA's data center division's sales rose 56% compared to the same period last year. But with $41.1 billion in sales, NVIDIA just missed analyst estimates of $41.3 billion. Still, its data center unit is, alone, larger than any other chipmaker in the game and accounts for roughly 88% of the company's total sales. H20 was dry. Questions linger over NVIDIA's ability to corner the Chinese market, and it didn't sell any of the lower-powered H20 chips it designed for China their last quarter, following the Trump administration's tightening of export restrictions. One exec said during NVIDIA's earnings call that between $2 billion and $5 billion of H20 chips could be shipped to China if geopolitical tensions settle down. But semiconductors have become a key bargaining chip in the trade war with China. Big picture, AI spending is a major force in the economy, with companies expected to spend $375 billion globally on AI infrastructure, like data centers, this year, according to UBS. That investment is expected to reach $500 billion by 2026. But some analysts worry that NVIDIA's tapering earnings don't just represent the company's skyrocketing growth normalizing, but instead are the first sign that AI spending could be slowing.